Alright, so we were discussing about the technical analysis and we have learned how technical analysis can be pretty useful for you in order to time the stock. Always remember, technical analysis will never tell you what is the fundamental or intrinsic value of the company, whether the company deserves the price or not. It will only tell you how the price is moving and what is likely to be the direction of the price going forward. That's all. Example, you are dealing in land. Now you have decided that you have to invest in Shamshabad. You are not looking at any fundamental factors. Someone has told you that in Shamshabad the investment seems to be good. So what you'll see is last 3 years trend, you will see how the prices have been moving, and based on that you would invest. Why the price is rising, you don't know. No technical analyst will know what is the reason behind the price rise or fall. The price is rising, it's likely to rise, that's all he can say. But why it is rising, what are the fundamental factors that is driving or pushing the prices higher, that he would never know. That's the beauty, I would say, of technical analyst. Now, is it a good factor? Yes, it is. Because let's say by looking at a chart, he feels that it's a compelling buy. But if he looks at the fundamentals, it may not support it. But stock prices can move higher even though the company may be bad. Because there are a lot of operators which play the game. You may have already watched the movie Harshad Mehta's Scam. In case you haven't, do watch once. There's a lot of learning also in the movie. So, stock prices can be inflated for a very, very long time. Even today, when I go with the fundamental analysis, I see a lot of companies which have zero value. Intrinsic value, there is nothing. Only loans, no assets at all. Still, they are trading very high. Operators are playing the game. And always remember, wherever the public float for any stock is less, I repeat, wherever the public float for any stock is less, operators will target that particular stock. So free float market cap. Where can you get the free float market cap, and what is the meaning of free float market cap? Free float market cap means the stocks which are in trading motion. The stocks which are active, people are actively buying and selling. That should be very less compared to market cap. Let me show you an example. There's a company which I have, BPL Pharma, Bharat Parenterals. The market cap is 235 crore, which is anyway less. But in circulation, there are only 60 crore stocks. 60 crore worth of stocks. So if you see, this is just 25%. It becomes very easy for the operator to play the game. Very easy. And remember, I always told you, I believe it totally in cash EPS. We know what is EPS? Earning per share. Cash EPS is earnings of cash. There are a lot of businesses who don't earn cash, but they earn property. Example, real estate. Example, infrastructure. Whatever that they are earning, they will reinvest. But these are the businesses which are generating hard cash, which will be either used for buyback or for dividend. High cash flow companies are always safe. Okay. Now we have missed one topic of screeners. We'll first cover up that as well. Now, fundamentally company looks very good and the free float market cap is also very less. That means you can easily take a bet on such stocks in case the chart pattern also supports. Now whether it is a buy at 400 or 420, 430, that we would see. But a free float, whenever a company has got least, it becomes very easy for the operator to play the game. you should be having such kind of stocks in your portfolio which are fundamentally strong, so that you have margin of safety plus you have a chance of operator playing the game. We need both of these guys. Otherwise, if you talk about government companies, a operator can never target government company because government will be strictly monitoring the share price. All the government companies are fundamentally very strong. I would say that no company can match, no private company in our exchange can match with the fundamentals of a government company. But still, that cheap value will continue forever. The share price of BHEL should be 300, but it is trading at a discount of only trading at just 70 rupees. It's at a deep discount, but that deep discount will remain forever. What is the use? We want to make money, right? We want that hype to come. That hype will come in private companies, not in government companies. You may not find any private company as cheap as BHEL, but at least, even if it is double the value of discount, if not 70% discount, at least 50% discount, if you are able to find any company, then you should be able to make fantastic return. And all what that we have learned so far, had you invested in the early stages, you would have made definitely huge income. I was talking about the other day, the growth factor, Bajaj Finance and all that. So we had compared, right, when we were discussing about the PEG ratio, we had compared various stocks. I remember Praveen has done that work beautifully and sent an Excel sheet which I even shared it here. So there we found that Bajaj Finance is not cheap, but IIFL Finance is very cheap. Let's have a look at the chart. So in the long run, if your study is good in the long run, you would definitely make huge income. So in the last 1 month that we have begun our training, the price has been down around 5%, 4-5% approximately. Yeah. But let's have a look at the price of IIFL Finance. See, 9% up. So you are buying a company which is very much undervalued. We have known through the Excel sheet that the price of IIFL Finance should be at least 800. And you are going to see the price to go to 800 within a year or 1.5 years. That's going to be a 70% return. Amazing return. But Bajaj Finance may not give even 7% return. May not. Even if it does, then maybe second year it will be bad. Comparatively, in finance, compared to Bajaj Finance, IIFL Finance is much better and the long run is going to reward you huge. So there is no doubt that fundamental analysis must be done. Only on those stocks we will be doing technical analysis. Let us quickly see the screener which we have missed it. Now we have known all the ratios, important ratios like PE ratio, PEG ratio, ROA, ROE, profit margin, operating margin. Then we have seen the dividend yield, debt to equity ratio. All those factors we have seen which makes a company pretty strong. But how do I check for each of these companies? Because there are 7,000 plus companies and every 3 months they are coming out with the results. That means every 3 months their numbers will change. So we can't keep doing this task every 3 months. And even after that, we can't even have so much of patience to scan even 1,000 companies. We want a ready-made work. I first want to know companies which fit my basic criteria so that I even study them. First, set a criteria where a company becomes eligible to come in your radar. A company becomes eligible for you to study. For that, we use screeners. And there are n number of screeners. Just in Google, if you search Indian stock screeners, you'll find plenty of them. Screener.in is here. Ticker tape is here. There's Edelweiss also. This is one screener which I usually love. So there are many. It is up to you what you like. Firstly, give the headline as screeners. So screeners are nothing but the online tools for you to filter the stocks that meet the criteria. With the help of this, you can shortlist the companies that fit basic criteria for further research. Do not blindly buy the stock just because it has fit your criteria. You need to dig deeper. Out of 7,000 companies that we are doing researching, maybe we'll have to do research only for 150, 200 companies. That's all. So let us fit a basic criteria here. We'll use Edelweiss screener. So book value. Okay, did we miss the book value factor in fundamental analysis? We haven't discussed book value, right? Okay. Quickly note down what is book value. The net asset value per share. Please note down. Alright, so book value is nothing but when I see for any particular stock, let's talk about a company like, say, Infosys. So the share price of Infosys is 1593, while the book value, if you scroll down, you'll be able to get that. Book value per share, this one, is only 180. So what it means is that if Infosys is to be shut down today, if Infosys decides that I just want to wind up the business, I'm not able to maintain the business. After paying for any loan that it has taken, in case it has taken any loan, then it will clear all the loans, and then whatever is left out of selling the properties, the cash, the building, car, everything, whatever is in the name of the company, they sell out everything according to the rule of the market. They have to give this money in the ratio of investment to the shareholders. That means for every share you would receive only 180 rupees. You would receive only 180 rupees. So that means there is a huge risk in investment. The price quotation is 1400 rupees higher. That means the goodwill value of this company is 1400 rupees per share. Share price is 1600 and goodwill value is 1400, which is like more than 85%. Then is it a good investment? It can still be a good investment because it is not easy to create Infosys. You may start with an IT company by taking 100 crore property, but will you be able to command a book value of, a share price of 1000 crores? No. The share valuation of 1000 crores will only come when your name becomes so popular that you get orders automatically. That is the stage that Infosys is right now. A new company versus Infosys. A new company has to struggle to get orders. Infosys gets orders automatically. Companies are approaching him. So that is why it quotes under a premium. But there are few companies who have been in the market for a very long time, yet their premium quoted is very less. So let's take an example of, first we'll see Reliance. Reliance Industries is also quoting premium, but not as much as Infosys. So book value is 1200, share price is 2500. That means in worst of the worst case, 1300 rupees is what you will get even if there is some kind of natural calamity, some kind of say COVID and all, and the entire world is struggling. Reliance is not able to run the business. It has to sell off everything what it has got. You can expect 1200 rupees per share. So there's 50% margin. Within this 2600, 1300 rupees is only the property value. That is what is book value. And some companies where the discount is too less, example. So share price is 111 while book value is 119. Look at this. That's what I told you, government companies, this is the problem. They are very safe, but returns are also going to be little only. Why? Because no operator can play with their stock, and when the operator is not there, that hype will not come. They'll continue to remain undervalued for very long time till government decides to sell their properties. Like today, MTNL and BSNL are huge loss-making companies. But the day government announces that we are going to sell the properties of MTNL and BSNL totally, the land what they acquired in the metro cities 50-60 years back at peanut prices, today they are all worth multi-billion dollars. These companies can easily become one of the best real estate companies, not telecom companies. So the day government announces this, the price of both MTNL and BSNL will shoot up 10 times, 10 times. Because their goodwill value is nothing, it is in minus. Even here also it is minus. So these companies won't have goodwill value, but they'll have lot of intrinsic value. Now, should you invest or not to invest, that is your decision. There are plus point and minus point both. Plus point is what? Safe investment. Minus point is what? Don't expect that your money will double easily. Takes time. Even if you follow the market cycle, private companies will rise faster than the government companies. That difference in valuation will always be there. It's a standard benchmark for it. Yeah, the game will change totally the day government decides that we are privatizing a company. If government says that we want to privatize ONGC, we want to privatize GAIL, we want to privatize NMDC, then definitely you will see that the price may increase by even 8 to 10 times. But is it so easy to happen? No, it is not. Every time that the government wins, whether it is Congress or BJP or whatsoever, they do promise that we are going to privatize the company, we are going to privatize. That's an election mudda. But these things to become a reality is not easy. Because the government employees will come on strike. The employees working in NMDC, according to the law, the court will support them. Only when employees say that yes, you can privatize it, then only company can get privatized. So government definitely wants to do it in a day. They wants to privatize all the government companies. They are ready for it. But objection is from the employees, and the court has to favor employees, not the government. So one company has still happened. IPCL, Indian Petrochemical Limited. A government company went in the hands of Reliance. First time it has happened in the history. Some people thought that it is impossible, but it did happen. So how did government manage to sell that? So government had put a condition on the buyer that you should not fire any employees. You have to, even after minimum 5 years of job, you have to guarantee. And even when you want to remove them from your company, minimum 3 months salary you need to give. Like that, all the conditions the government had put it to the private company that before purchasing, please read all these conditions and strictly you got to follow it. Otherwise, we can take back our company. All the employees were satisfied, saying that okay, all the points look in our favor. So everybody signed it. Majority of 51% votes they have got from the employers, and court did not object it, and the company became private. Price increased by 3-4 times. So like that kind of things they need to do it. That's the only solution to make a government company private. But I would say that a government job, even today in rural India, when you see, people still are fond of government job. Why? Because of the lucrative benefits. First is the government employee gets a lot of benefits apart from just their salary. Second thing, even if they do not work, they get salary. Third thing, they get pension also. So like that, so many benefits are there which they do not want to leave. Maybe in metros it can happen, but in rural areas, more than private job, they love government job. So companies becoming privatization is only on paper. In reality, it is very difficult. That's why while investing in a government stock, be mentally prepared that your money may be safe, but growth is also going to be limited. Because every time that support will be there, as the price falls down, again a support will come, because companies look too cheap. So most of the time the price of the company would be higher than the book value. The differential premium is nothing but the goodwill value. Alright, now coming back to the screener. There are few companies whose book value is in negative. Example, Zomato. Zomato book value is in negative. Why? Company does not have any cash. It is taking loan to pay the salary. Why? Because company is burning cash. Why burning cash? In order to acquire the customer. So company has to pay the salary to the employees, company has to pay to the delivery guys. They are paying to delivery guys 50 rupees, but they are charging from you only 40 rupees. They are paying huge cost for the server, for maintenance of the app, for the security. So you'll see that Zomato book value may be like minus 2 rupees, 5 rupees, 10 rupees, like that. So many companies as such, startup companies mainly. Baiju, then you have got companies like say Matrimonial, Naukri. They are still not profitable. Then why are people still buying the shares? A day will come wherein even if they increase the delivery price from 40 to 60 rupees, people would still continue to order food. That stage has to come. When that stage comes, company will become profit. So that potential is there. That's why people are buying the shares in advance. So this is the maturity of investment. If you look at the current scenario, there is nothing in the company. But if you look the future outlook, now it has become a trend to order food online. Even if the price increases by 10%, you would still continue to order because that thing has already happened in America. Time is not far in India. And when that company is increasing the price, yet people are still being active in ordering food, this can be a game changer. Then there will be huge cash flows, just like Uber. Uber was also in this stage where Zomato is 5 years back. 5 years back, Uber condition was like Zomato book value negative. Now is able to generate a lot of cash. Even Jio, for the first year, book value was negative for Jio because he gave you free outgoing, but he has to pay to the spectrum fee, to the tower for tenants and all that. He was a tenant in most of the building for installing towers. He had to pay the rent for the tower. He had to pay the spectrum fee. He had to pay for the distribution, marketing, for advertisement, everything. But what happened? First year was negative book value, next year was plus 3 rupees book value. Then it became 46 rupees. Like that, continuously it increased. But the share price was never zero. Because intrinsic value is zero, right? But there is futuristic value for the company. That is why the stock price is in premium. Stock price is always in premium because the future is bright for it. Right? So now coming to the book value, I want the stocks whose book value is minimum 0 to maximum. Enterprise value 0. Total asset value minimum should be 0. Okay. Then apart from that, what we would want to add is P by E ratio valuation. And then we would want to add PE ratio. Price to book value not required. P ratio is important. ROA, ROE. Anyone would do. Let us take ROE. For ROE, let us set a condition minimum should be 20. So how many companies have come? We found 500 stocks matching your criteria. So we are not going to scan 7,000 stocks, but only these 500 stocks. So let us see which good companies may come up in the results. We don't require book value, enterprise with total assets. Let's only take these two figures and market cap. Okay, market cap we can check manually. So these are the companies whose return on equity is minimum 20. Remember the cement example that I had given to you? Any companies whose return on equity is higher, the company can expand the business pretty fast. Alright, and P ratio will tell you how expensive is the company with regard to the growth. These two are the main factors. Then you have to open the company and see what is the debt it has got, who is the management, what is the dividend yield, cash flow. You have to see what is the operating profit margin. That all that you need to see. But do not ever get tempted by looking at such absurd values in the company. The return on equity of 100, 200, 300% is only once in a while because of a sudden rise in profit, maybe because of a large deal, or maybe because of sale of any property like land. Okay, so quickly note down one point. Just hold on for a minute. I'm getting a important call. Okay, so never ever blindly buy into any company just by looking at the good parameters. Dig into the company to find out whether so only when we see that the valuation is getting better and better with every year, it's not just one off, it's not just temporary for a year, two or three, it has been a trend for the last 3 4 years, then definitely we can attempt to buy. So let's see, here we have got a lot of good companies, but believe me, in this 500 companies, at least 400 where the numbers are good are only temporary, and very easily you can find out. We will see how it is. There is only could be one off because of some good sale and all that. Only 100 companies would be as such where it is worth investing. So let us start with CMS Info Systems. Okay, so this is not that great parameter. We'll just put the return on equity in the descending order. Okay, Vanbury. Let's have a look at Vanbury. Looks like a very compelling buy because P ratio is only 16, return on equity even 50. I am fond of such company. I am totally impressed, and here it is 300. Let's see what is so special about Vanbury. It's a pharmaceutical company. So suddenly there has been an increase in the revenue. There has been a sudden big increase in the profit, which is not usually the trend. So this is suddenly which has come. But whether this is going to repeat or this may happen. Next year it may be like this because people may have got trapped again before in 2020. There also company from huge losses may have come into profit and people would have thought that it's an excellent company. What happened next year? A big setback. It's coming back on track. So now this could be due to COVID, but this was also COVID. So we are not sure how the next year is going to be. But next year again, if you find it in profit, maybe even little less profit, I would still say that the numbers would be excellent because what is the market cap company has got? Only 177 crore. So such a small company with such a heavy profit, if the trend continues for next year, then we may definitely buy. But according to me, most probably the trend may not continue. Because if really it was to be continued, the technical analysis would have given us a signal, but here the signal is actually a sell signal, guys. That later we'll understand. How can we say through the chart that the next quarter may not be that good? That only time will tell us. But there's no consistency, at least this we can see it's zigzag. It goes up, then comes down, then goes up. So if it is volatile like this, then this is likely to be the trend. Let's see some other company. DCM. So should be the case even with DCM. And do not directly believe on the numbers shown in Edelweiss. Also check manually. Sometimes even Edelweiss also may make a mistake. They may not have updated the data in the backend, or instead of quarterly they might have considered yearly profit. We never know. So always check manually also. So DCM company is also very small, just like Vanberry, but what has been the trend? Okay, totally fallen down in the revenue. Okay, so most probably as the revenue is falling, it may continue to fall. The trend is downwards. The net profit has been though good, from minus 24 to minus 16, then 25. Looks like a good trend. Here though we have seen one dip, so this is little negative. Company from minus 35 had come back to profit, but then came back to losses. But this was COVID. Now this is the problem right now with each of us. Even me and you have to face this issue because these 2 years are unusual years. So it's very difficult for us to judge whether a company is good or bad taking these 2 years into consideration, because even good of the good companies had posted losses during this. Now these losses are due to COVID or is it an operational loss? For that you may have to dig little deeper inside the company by looking at the annual reports. So I'll be showing you after technical analysis where annual reports can be seen. Every year company will release a book. In that book they are going to write everything what happened during the year. So if they mention there clearly that the losses what we made was only due to COVID and now we are not going to see such kind of losses again in future, now we are back into profit, we are doing excellent business and all that, when you find good stuff, and then we also read the management to see whether what they say is genuine or not, or it's a fraud management. Now that everything thoroughly when we check, then we can have the confidence that this was only temporary. This is likely to be the trend. Then this can be a game changer. If really that happens, it could be a game changer. Because return on equity is very strong. Okay. EPS is growing. From the last 3 years perspective, it is growing. But before that, there was a fall. So this should be likely COVID. but only when we dig deeper we'll be able to confirm it. So look at this company. So ROE, ROA, or market cap, from all that perspective, it looks good. Let's also have a look at a book value. Company is very expensive compared to book value. Even without digging deeper, I can tell you that company's loans are very high compared to assets. Let's have a look. Let's go to the balance sheet and check once. So if the company is trading too cheap, there should be some game. And maybe the game is in loans. You have 10 crore, but you are taking a loan of 100 crore. It is like moving with the fullest speed. Either you meet with the accident or you reach the destination fastest. Short term borrowings is 23 crore. Long term borrowings, they don't have any. Reserves and surplus is in negative. So company is already sunk into the water. So if company sells out today, I don't think that we would even get 6 crore. In case a company comes back to profit the next quarter, then this minus would gradually turn to positive. But right now, the stage of the company is as such that the loans are pretty heavy compared to the assets. That is the reason why the book value totally deteriorated. Especially during those two COVID years, a 144 crore company has made a loss of 60 crore already. But that is history. This also you need to consider. That 40 crore loss which has directly hit their net worth and went into negative. Now that they are coming back stronger, another year if they do that, then this could be a jackpot. But we are still seeing the topography. I told you we have to dig deeper. This is only first stage scanning. But company definitely worth study. Vanbury, no surety. But DCM is one company which becomes eligible for us to further study. Likewise, let's see next company, MRO Tech Reality. So it's a real estate based company, so likely that they might have sold any land. So that profit could be one off. Let's see. And everything will be written in the annual report. They will clearly mention that this profit we made because we sold that kind of IT park to so and so investor. Now we are likely to invest into another IT park, like that. They'll be mentioning everything. See, so usually the trend is bad. Company goes like this, then goes up, then has come down. So it's not a consistent growth like this. It is zigzag. So zigzag means if it goes up, the next option is only to come down. So these are like value traps, See, we would never invest into such companies. So this is a temporary one-off because of maybe some huge property sale. By looking at these numbers, we will not know it. But if you go into the annual report, that is likely to be present. Because the last 4 years data is saying it. This we can understand COVID years, but what happened here? 2021. Most of the companies already recovered. These 2 years we can give to COVID, or otherwise these 2 years we can give it. Then why such a minor profit here? Why such a huge profit in this year? So doubtful. Again, maybe digging further, we may see that company may still be good, but so far doesn't look consistent. Then you have to dig deeper into annual reports. Standard Industries, Pantheon Digital. This is an excellent company. Let us take a company which I've already is well known to me, where I've already done research. Let us take one such company. Nestle India. Remember FMCG? Colgate Palmolive, I already told you, an amazing company for investment. Sport King India. Let us read this company. Looks very interesting because there are very few sports-based company listed in our exchange. Share price is 670. Never worry about the share price. Always look at the market cap, 890 crore. So it's not micro cap. It's almost like a mid cap. Okay, excellent growth in the revenue. This is all in thousands of crores. So it's not a small company. But again, problem here is that 4 years have been very stagnant. Suddenly that big profit has come. Whether it would sustain or not, no guarantee. Okay, excellent. We have seen a sharp increase in the profit. 19 went to 24, 24 unfortunately went down to 12, maybe due to COVID again. But then 84 has become 409. Let us see next year, 2023, maybe one more year we need it to further evaluate the company. If it is beyond 400 crore, then there's no doubt that we got to buy. But if the trend changes and it goes for a dip, then maybe 2-3 years of stagnant period may be there. Never block your money. The faster you change hands, the better returns you get. Because it's all power of compounding. So EPS is nothing but the reflection of net profit only. Return on equity seems to be good. Consolidated. Okay, there is no consolidated, only standalone, which means that company has only core business, no investment business at all. But see here, that's the difference that you find. This is 53 ROE. Here it shows 72. So maybe this data is not updated, or maybe he has taken the fresh quarter also into consideration. So better you check manually. Okay. Jindal Photo is a good company. And then coming to some company where I've already done research. You can even download this in the Excel sheet. Tapi Froze Life Insurance. Gravita is a good company which is into recycling. Manali, Petrochem, Max Venture, TCS, Coal, Imami, Jubilant. Gufic Biosciences. In fact, this company I've recommended a lot of them. This is also a good company. Let's have a look at Gufic. So as I usually recommend the company, there is one company that I recommend, EIKO Life Science. So those who are planning to buy the stock for short-term and long-term investment, they can enter into this company, EIKO Life Science. Story will be when we have a lot of time, that time I'll be discussing. But right now, a good investment bet. This is the company that I'm talking about. Okay. Later when we are free, we'll be discussing all that. Right now, by looking at a P ratio and all, you may laugh at it. Later we'll understand the fundamental story. Never invest from current conditions, look at from future outlook perspective. So Gufic Bioscience, let's have a look at this company. So I already hold some shares of Gufic Bio. So P ratio is okay, industry P ratio is okay, and book value, okay, it's a pharma company, it doesn't matter that much. 2000 crore company. Let's have a look at the readings. Okay, 300 becomes 350, 350 becomes 378, 378 becomes 487, 487 becomes 780. Amazing growth, guys. This is what we want. The trend should be whether the company may grow by a less margin, but this growth has to continue. So one thing that this company is resistant even to corona. Basically, it's a pharma company, so that time, of course, pharma companies were still doing good. But whether before COVID, during COVID, post COVID, company has not even got a small slight in the hit. It continues to grow. This is what I love. Then let's have a look at net profit. Oh, that also grows. Excellent. Just amazing. There has been a sharp increase in the profit in the last 3 years. And previously also there has been a growth. And not just based on this number, I've already done the research on the company, recommended to a lot of students. I'm going to put down in the notepad also. I myself have a lot of shares of it. I've invested 2 lakh worth of stocks in this company. In fact, I invested in 214, you are getting it only at 203. Okay. So maybe today itself you can attempt to buy. Return on equity is also improving. So overall, company looks like an excellent buy. For portfolio. Okay. So after 3 months, 6 months, after a year, what all recommended stocks that I'm, whatever that I'm keeping a note of it, put down in the Excel sheet and keep tracking the prices. Only then we'll get the confidence that yes, the recommendations given by me are working or not. Okay. This is a promoter stake, guys. Okay. So the shares of the promoter is 75%. Very few companies you would find where the promoter stake is pretty high. This is one such company. Later tomorrow we'll be discussing the charts also. This company's price band. That means this is an excellent support zone for the company. So another 2 4 rupees that it falls at approximately 195 till 205 is accumulation zone. In this range you got to be attempting to buy. Company price was 290, so already you are getting it at 172. And one company which I haven't found here but I still feel is an excellent company is Gujarat Container. I'm having lot of stocks of this game. 6,000 shares I have of Gujarat Container. What is that I'm expecting the price to be here? According to me, even today the price should be 500 according to the fundamental parameters. So company is already available at a 60-70% discount already, and there's a huge growth already happening and is likely to happen for another 2 3 4 years. So even if it goes to 1,000 rupees, I would not be surprised. One 172. So first of all, a small company, I love that. P ratio is already clearly visible, only 7. The price had already gone till 270. It is down to 170. You're already getting a 100 rupees discount in the price. But the growth wise and everything, when you check, it's an amazing growth. So 58 had become 79, COVID years. 75 became 87, then became 150. I'm expecting 220 crores in the next year. 220. Okay. Let's have a look at the net profit. Such a sharp increase in the profit. The company's fortunes have just changed, guys. So from few, it is not zero, it is few lakhs of profit here. The company, whatever that it had planned it, unfortunately a setback of COVID had come. Price went down to even 45. Now imagine a company's whose share price I have seen as 45, even at 170 I am recommending to buy. Because we know what is the intrinsic value of the company. Return on equity, just amazing. Such kind of trend, when you have it on return on equity, the price to double up doesn't take time. Okay, you must have in your portfolio. So the book value is increasing continuously. That means the company properties are increasing because of the rise in the net profit. EPS, earning per share, look at the trend. I told you, always refer this figure for the real growth. None of the other figures we can trust. So 1.3 becomes 1.65. Here there has been a slight hit because of COVID. Then 5, then 16. So per share they are making 16 rupees profit, and it is likely to be 20 to 25 because of the recent growth that we have seen. And then you'll get more confidence when you go into the annual report. So there you'll realize that the worst performing, whatever it was, like few lakhs, that is likely not to come again in the future for the company. Now the new trend is that it has the new benchmark for it is 7 crore, 8 crore, 9 crore of profit. On a 100 crore company, even if you are making 10 crore profit, return on equity wise, the company price should be minimum 500. Alright. And plus the ratios are improving. Further, if you look at the PEG ratio, what is PEG ratio? PE ratio divided by growth. And we have seen that 1 is appropriate valuation. Anything below 1 is discount. And how much discount? That much better investment. So quickly, if you go through the PEG ratio, P ratio is 7. For PEG ratio, we need the P ratio. Okay. So 7. TTM means trailing 12 months. So the recent 12 months P ratio is just 7. And what is the growth percentage also we would see. Where has it gone here? Sorry, it was like 34 lakhs some profit. So there has been a growth of around 7 times. Here there has been a growth of around 3 times. 3 plus 7 is 10 divided by 3 average figure. That means company is growing by 4 times in the last 3 years. And the P ratio is only 7. Let us quickly calculate the PEG ratio. 7 divided by 300. Sorry, 300. 3 times growth. 0.023. That is the PEG ratio. Show me any company in our exchange which has got this kind of PEG ratio. A PEG ratio of 0.1 itself is like a jackpot investment. This PEG ratio is 0.23, guys. Deep discount. And you're already getting the price which is 100 rupees down from the top. Company even at 280 felt like it would go. When I bought it at a cheaper rate, I've seen 280 also, but I did not sell even a single share. The price is back to 170. I'm still remaining passive. Rather, I've added recently at 173, 174, 182, 186. The price which I've seen at 46, even at 4 times higher price, I'm still buying it because the study is of that level. Alright. Someone like say, you might have bought a land for 10 lakh rupees an acre. and within 2 years the price doubles, where you are not selling, you are buying further 20 lakh rupees an acre. Next year you are buying it at 30 lakh rupees an acre. That means you know what is fundamentally deriving the price. It is not an hype, there is a fundamental reason. Maybe some big road has been sanctioned, or maybe some kind of big industry is being set up. Okay, or maybe there is lot of urbanization. There could be n number of reasons. Only when you have that confidence that fundamentally things are changing, then only you would be buying, even though expensive, though you have seen the price too cheap in the recent past. So that confidence level will be there in you when you have the knowledge about it. So having a knowledge about a stock will give you confidence when the price is falling down. So the price of Gujarat Container falling from 280 to 180 does not create panic for us, it creates excitement, guys. That is the difference between a person who knows what is the company rather than a company who is blindly following the media tips. Someone who has recommended, let's say in Facebook or in Telegram or in WhatsApp, that buy Gujarat Containers at 270, at 170 definitely is in panic. If he doesn't know anything ABC about the market, he has just bought on the basis of a tip. Today is in a dangerous position. He may not hold it. Maybe he have already exited at 200 or maybe 180 or maybe at this 170. But as that you have knowledge, you would stand and you would buy more. And you will be rewarded eventually. Okay, so it's already past 9. With this, we end today's topic. We could not see any charts today. I thought of seeing some of the chart patterns. Anyway, tomorrow we are going to begin with the technical analysis. Theoretical we have already seen. So we are going to see practically some charts. Then we are going to see the famous theory of Mark Minervini for intraday and for short-term trading. Tomorrow we will be only discussing technical analysis for investment. If you want to buy a stock and hold it for few months or years, then what you have to be doing there.